Hello and welcome to ACG Wealth Management's October Investor Insights video. I'm Bobby Moyer and I'm joined with my colleague Jimmy Pickert. Let's jump right into the numbers. The S&P lost 9.2% in September and is now down 23.9% year to date. US mid and small caps also will perform poorly, generally in line with the large caps. The S&P mid cap lost 9.2% and the S&P small cap lost 9.9%. Bonds did not do much better. The Bloomberg Aggregate Index lost 4.3%, bringing its year to date loss to 14.6%. A 60-40 mix of stocks and bonds has now lost 20% year to date. No sectors were positive in September. The best performing sector was the healthcare sector, which only lost 2.6%. The next best performing sector were financials, which lost 7.8%. The worst performing sector during the month was real estate, which lost over 13%, and communication services, which lost 12.2%. Energy remains the only sector positive year to date, and it is up by 35%. Rates and inflation were once again a major story in the markets. The two-year Treasury yield closed August yielding 3.45% and finished September yielding 4.21%. The 10-year Treasury closed August yielding 3.13% but finished September yielding 3.8%. These are very large moves, especially over a 1-month period of time. The yield curve continues to be substantially inverted, with the 2-year yielding 41 basis points more than the 10-year Treasury. So Jimmy, those are some pretty dismal numbers we saw over the last month. What were kind of the highlights of the month?
Well, not to sound like a broken record, but it was inflation and the Fed's response to get it under control. But I think that the way that the story is changing a little bit from how we've seen it for the first 9 months of the year, markets are really starting to understand that the Fed is committed to get inflation under control. And because they can't control the supply chain, they can't create more supply in order to help alleviate prices. Really the only lever that they can pull is tighten monetary policy in an attempt to get demand down. And there's all sorts of nice ways of saying that, but Jerome Powell, the Fed chair, has been using the word pain a lot more over the past couple of months, really since his speech in Jackson Hole back in August. And I think that it's fair to say that the market reaction really since that Jackson Hole speech in August and through all of September is a recognition that we have to go through this period of economic pain if we're going to get this inflation under control.
Yeah, it's almost like everybody wanted to have a soft landing and the Fed was going to pivot with that soft landing. But really the pain you talk about is we need to have a little bit of a hard landing or the consumer won't stop spending. And if the consumer doesn't stop that spending, well then they can't really hit that demand side of it. So I think that's what the market is starting to realize here is there is going to be some pain and people may lose their jobs and the unemployment rate may tick up in order to kind of get some of this inflation under control, and they're not going to pivot until they see that, which unfortunately means a little bit of pain in the economy.
So the Fed hiked interest rates 75 basis points again in September. That brings the federal funds rate to 3%, and that's the highest that we've seen it since January of 2008, actually. And so it'll be really important and critical for guidance put out by Powell and other members of the Fed committee between now and the end of the year just to see where things go from there.
Yeah, we've seen a lot of things with other central banks across the globe, the UK, Japan, China, all intervening, but more because of instability of the markets. And maybe that's the only way that the Fed does reverse course or at least lights up is to protect the stability of the markets. But I don't think anybody wants that either, right? Because then inflation will continue to be high and then we have, other issues along with that.
Exactly. So Bobby, naturally, after everything that we've just been talking about, the pain experience in the markets and the likelihood that things could easily get worse before they get better, it's understandable for investors to wonder what should they be thinking about with their portfolio? Where do we go from here?
Yeah, it's the natural reaction is to want to go to cash, or the emotional side go to cash or lighten up. But really, we're 24% lower than where we were 9 months ago. Interest rates are significantly higher. We haven't seen this high of interest rates in decades. So from an attractive standpoint, we're at a pretty good place with the markets. And generally in a recession, the market falls below 30%. Well, if we're already down 24, sure, we might go more than 30, but we're maybe halfway, more than halfway already down. So the pain's already felt and we're already there. So the boringness of staying the course it is imperative now that you stick to your plan and not make reactions, even though it might get ugly or worse before it gets better. And as we always talk about, the market tends to bottom before the economy. So even if things do get more painful and the market, the economy, they bottom here in a couple months, the stock market may bottom before all that. And you want to be invested because we know coming out how high those returns are, that if you miss those, you never get those back when you're coming out of that bear market.
Right, Bobby. I think that it's just a great lesson so far this year about how what an investor should think about the market and the sentiment that's out there can sometimes wildly disconnect from the actual fundamentals on the ground. And you think back to January of this year, there's a lot of euphoria, a lot of exuberance in the marketplace. People were talking about adding risk to their portfolios, but stocks were about a third more expensive then than they are now, and interest rates were yielding next to nothing. Would you rather be an investor in stocks and bonds at that time, paying those higher valuations, or would you rather be an investor today with stocks 2/3 as expensive as they were 9 months ago, and the yield on a 2-year treasury now yielding over 4%? I think I'd pick the latter.
Yeah, Jimmy, I think that's a good point, and Warren Buffett said it as well. Be fearful when others are greedy, and greedy when others are fearful. And this is one of those moments where there's fear out there and people are being fearful. So maybe more of a time to be a buyer than a seller, or at least holding your positions as opposed to selling.
Excellent point to end on. Thanks for joining us. See you next month.